Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
What is price telling you about your money? Huh? I'll wait. No, really. What is price telling you about your money? You should ask your advisor what he or she says. Ask them about price. Ask them about price on any and every position in your portfolio, and ask them about the intercorrelations in your portfolio. Ask them about the expected drawdown of the total portfolio in any given day if we just have a massive sell-off route. Are they measuring that? Are they looking at those numbers? Are they really paying attention all day? Or are they asking you for a tea time or lunch? Okay? So here at Revere, we say price is truth, no exceptions. Period. Price is truth. If you're arguing with price, you're arguing with truth. I learned a long time ago, look, folks, I got all these hoodly doodlies behind my name, all this fundamental analysis and economic stuff. It doesn't help me make money as much as the technicals and having rules and sell disciplines, because sometimes the markets just don't act fundamentally. They just don't act right. They don't act logically. The market is emotional. It's actually people's emotions. That's what we're measuring. The ebb and flow of the buying and selling of what people think. In any event, so you need to ask your advisor what price is telling them about every position in your portfolio, because this is your financial health, right? This is your financial health. So if they can't answer right away without hesitation, here's we don't use hard stops, but here's where our level is. Here's where we'd get out. Here's how much risk we have right now, currently today. We adjust that every day. More importantly, we put our money where our mouth is. Because at Revere, Don and I, the principals, the shareholders, are 100% in our money with these strategies, with Growtection and Turbotection. So we're not that guy on CNBC saying, this is the greatest thing since sliced bread, stocks and sliced bread, but I don't own it, my wife doesn't own it, my company doesn't own it, but you should. That's because there's a conflict of interest. You're the product. He's a salesman. He's delivering you to that company. Anywho, I'm not going to dive down too much, but first I would be remiss if I did not mention Don's Rockstar. Let me repeat, Don Vanderbilt, Senior Portfolio Manager at Revere, Don Vanderbilt, Don Vandenbord. God, I had that set up so perfectly and I flubbed it. Sorry, Don. Maybe Zach can clean that up.
I've only known you for 9 years. I can't expect you to get my last name correct yet.
Yeah, it's been a while. It's been at least I'm finally calling Jacob. We're going to talk about that next, folks. We got an exciting new hire. And we're going to bring that up next week. But this week, I want to talk about Don just had a Rockstar appearance with Mike Webster, a.k.a. Webby of IBD fame. He worked side by side with Bill O'Neill for years, and he's probably the last closest person in that IBD network, the fund managers, the guys that are kind of still, in touch and in tune and working there. And anyway, he has a weekend show, and it's on YouTube, and it's at Webby, W-E-B-B-Y. I don't think it's I-E. It's W-E-B-B-Y 5150. That's his handle. And if you search for that, and it's going to be out tomorrow, Saturday. Now, once it's published, we'll provide a link. We'll send out an e-blast or something. And if you can't find it, you can always, I'll send it to you once we have it. But here's the beautiful part, folks. First of all, this was, I think, Webby's, if I'm not mistaken, this is the first time Webby's ever had a guest on the podcast. This normally is his own deal where he's doing it. But Don did about a 2-hour and 20-minute interview, a long interview where he does a deep dive in all aspects of Revere portfolio management, our strategies, our sell rules, all kinds of stuff. He does a deep dive. For all you stock nerds, all you do-it-yourselfers or traders that really want to learn, if you're really serious about this, then go watch that. You need to watch that, because that's how Revere manages money. So I ask you again, what is your advisor saying to you? And what does he sound like? Does he sound like Don? I'm so glad for this link, Don, because next time I get some stock nerd, hardcore trader kind of type guy that really wants, I'm just going to send him that link and say, watch it and then call me back. Then we can have a good discussion. Anyway, it was a great interview, folks, and you need to watch it when it comes out. Now, I'm going to go to the mailbag now, and I'm going to do 2 mailbags to kind of bring you under the hood, bring you under the tent at Revere. One is a client that's been around for about a year and a half, and then we've got a prospect who's been following us on the trying to learn on our daily market insight videos. Okay. And I want to read these. And look, we had a bunch of other mailbags, and I couldn't get to all of them, especially MB. He always sends in great articles. But these 2 are kind of talking about the process of Revere and kind of how we do things. So I just kind of wanted to pull back the hood. And then we're going to go to Don and the markets, and he'll give a little overview of what he talked about with Webby on that podcast. But then he's actually going to go into what Price is telling us at Revere, how we should have our portfolios allocated. And then you can listen and you can decide whether your advisor sounds like that or not. Anyway, all right. So this was on 8/5. It's from PP. And it says, Dan, thank you so much for your time speaking with me yesterday. As I mentioned before, it is a truly honor to speak with any of your team members. Revere's daily YouTube videos is professional grade education, not taught anywhere. Thank you.
Nice.
Please accept my, I had to read that. Here, I underline this. Please accept my sincere thanks to you and your team. Folks, we put out more free content than any advisor in the United States that I'm aware of, and even in the world. We're doing a daily market video every time the market is open, every day, evening, right? And then the team, they're such hardcore stock nerds. They like their vacation on the weekend. They like looking stock charts. They'll actually do a few stock things on the weekend, and then we do this podcast every Friday. So you're getting probably 10 to 12 free contents at a minimum a week. What is your advisor doing? Is he out there on the golf course? Look at his annualized returns long-term and then compare them to ours. Anyway, I digress. Anyway, it says, also, thank you for sending me the relevant documents. Growtection and Turbotection both have impressive performance. I have one request to understand Growtection, and then in parentheses, or Turbo, better. I understand Turbotection is a new product. It's actually a strategy. So it's okay if you don't have many details. We don't, because doesn't have a long-term track record. Can you share today's value? This is a couple days ago, of $10,000. Oh, I love this Amazon. $10,000. You had 10,000, be 14 million today. Almost went bankrupt 3 times, but anyway. Can you share $10,000 invested on Growtection on 12/31/2019? I'm using the 12/31/2019 as a date that posted for the growth. I sent them a chart with different time frames, and that was a longer time frame starting in beginning of 2020. So I'm trying to understand how much the value would differ simply by sidestepping the bear market over the last 5 years. I believe the strength of your system and example would be tremendously boost my confidence. I will continue to review other artifacts from Ted and Connor. They are both amazing traders as well as Don. Thank you again, PP. PP. The question isn't total return. That's what retail people ask. But risk-adjusted return. Even if the returns were the same as the S&P or even slightly worse. If we're going down way less than half, actually approximately about a third each time, of the drawdowns of the S&P while matching the S&P, that's 1/3 the risk. You don't get scared out of your strategy. So if you lose 35%, folks, and you get scared out of your strategy, did you still have that strategy? Methinks not. Think of it as using, I'm giving him to kind of get him thinking outside the box. Think of it as using only 1/3 of the cash or assets to generate those same returns while leaving 2/3 out of harm's way, not available for loss or drawdown of your money. That's the name of our podcast. But if you get scared out of your strategy, did it work? Over the period of time you selected, we did beat the S&P by an average annualized rate of 0.83%, almost once, not a lot, or average of $66 per year with 1/3 the risk, turning $10,000 into $20,764 versus the S&P's $19,865. So essentially we made $900 more, or 9% simple interest over that 10-year period. So we beat the S&P by a little bit on that. TurboTax should probably do a lot better because it's designed to do that. Protection is designed to make S&P market-like returns, but with a lot less risk. It just did that. I just gave you those numbers. It slightly beat the S&P over the last trailing 5 years of this time period. Sometimes you're slightly ahead, sometimes you're slightly behind, but we don't ever have these massive drawdowns or bear markets. That's a good deal. Anyway, but with the S&P, you would have declined $3,500 on 10,000, then another $2,800 and $2,000 on that same 10,000. While we declined $1,400 versus 35, $1,200 versus 2,800, and 800 versus 2,000, respectively. That is risk management. So you don't have to change your underwear. I don't like changing my underwear when they're soiled. Is that your confidence? But that is your confidence boost with real numbers, in my opinion. Let me know when you want to start professionally managing your money so our money, your money, can look just like our money and you can have peace of mind. Anyway, by the way, this guy's out in California. He's actually kind of a banker. He works for a bank. He's like a loan underwriter or IT compliance or something. And so we're considered a financial company, and so is he. He's a bank or a money manager. So for his bank, he needs to get a compliance letter. I signed a little thing saying, yeah, we got full discretion. Anyway, he's going to get back to me. He's very interested. So that was the prospect that's been following us for a long time. This next one is from a ongoing client that's been here around for about a year or so, a little over a year. 6'2", MD. Hi, Dan, Don, and Merrill. I want to pass along my gratitude for your work. 2025 has been a good example of the service you provided, with the drawdown being less than the market, and you have done a great job catching the up move. My question is, do you handle money that is in a 401k plan? My mom has 2 accounts at Raymond James, and the difference in your performance and theirs is noticeable. I was going to ask if retirement money is something that should be allocated here in 2025, but here, however, 2025 has shown me I am comfortable doing that if you handle 401ks. Thank you, MD. Now, folks, always call and check. People kind of get confused sometimes. These were actually IRAs. They were not 401ks. His mom's elder, 80, 85, and she's retired. So I kind of knew that that's probably not a 401k. But even so, sometimes we can help with that if we can get at it on as an advisor. Anyway, me called a little bit ago and left you my contact and my cell number so you have in the future. Just calling to ask more questions about how your mom is set up, because I assume they were IRA. MD, thanks for the call, Dan. Appreciate the conversation. Here are the 2 statements at Ray J. Please let me know the next steps so I can reach out to Raymond James representative as a courtesy call before the funds are moved. So, folks, I'm not asking you to trust Revere. I'm not asking you to just follow blindly. I'm asking you to look at how you're doing, not only on your returns, your performance, total return, but how much drawdown, how much risk you took to get those returns. Compare them and then compare us, because this is your money. I got plenty of friends. I don't need more friends. My money manager needs to be a damn good money manager, period. This is my financial health, only second to my medical health. So for my medical health, I want the best damn doctors I can find. Don't you? Or are you going to self-medicate? You're gonna do your own doctoring? I don't know. But a bad doctor can get you in real deep trouble. Believe me, I know from personal family experience. Same thing with financial. I see that all the time, and it's scary. Folks, if you want a better way to invest, and look, we put our stuff out there every night. So just watch a few videos and see. Because if it's not a good fit, I don't want to take you on as a client because we're very active. We are not a pie chart or us. You will not get a pie chart or us portfolio, I promise. Price equals truth, no exceptions. Every position in our portfolio has to earn its way onto our portfolio. We do not pre-select securities. And then it's got to continue to earn its way to continue in our portfolio. Otherwise, it is cut. So ask your advisor, how did this stock earn its way onto my portfolio? And how is it continuing to earn it? And is there a better substitute? Those are the questions you should be asking to your advisor, and he should be or she should be able to answer you without blinking. Now, without further ado, because it's your money, name the podcast is not their money, we're going to find out what Don and the team, what Price is telling us where the best place is for your money and my money and Revere clients' money. Because it's not about your risk tolerance and your time frame. It's about how much risk is in the market, the sector, the stock itself, and the market's time frame. And then you need to dovetail your needs and your risk and your time frame with the markets, because the markets trumps yours. The easiest example I can think of, you tell me you're very aggressive. If a stock is crashing, should I own a crashing stock? Do you want me to hold a crashing stock for you? Well, you're suitable because you're very aggressive. You can ride out that volatility. Yeah, I prefer not to. At Revere, we don't hold crashing stocks. It's just not in us. That's not the way we manage money. There's a better way to invest, and we're showing you how we're actually making very, very good returns with less risk, not more. You've always been told to make good returns or make better returns, you have to take more risk. Folks, you've been lied to. So for a better alternative than pie charts or us, whether that's target date, asset allocation, or some 60-40 with some random rebalancing, let's find out what Don and the team says about your money and how it should look. Don?
Yeah, thanks, Dan. You mentioned comparing. It's kind of interesting. Everybody wants to know what a portfolio does relative to the S&P 500, but no advisor puts a client just in the S&P 500. In fact, in most cases, advisors don't take enough risk on when the market is in a strong uptrend, and that's another reason why we beat the S&P 500 long term, but we destroy these 60-40 portfolios that other advisors have clients in, because they're filled with emerging markets, international stocks. And now those are fine in 2025, but they haven't been for the prior 5 years, as well as bonds.
25 years. Anyway, go.
Yeah. But one source of alpha is knowing when to push your beta, and that is when to
Oh my
be
gosh, that's a
overexposed
classic
to
line.
the market. Right. And that's what we do when we put out our RVAB score for our two portfolios in every video. A fully allocated portfolio to the S&P 500 has a 1.0 beta. Like you mentioned, you'll get serious drawdowns with that periodically. 22% intraday, most recently 35% during COVID, 28% during the 2022 bear. And that's where we excel, is by limiting our drawdowns relative to what the S&P is doing, because we know, simply put, all bear markets happen below the 200-day moving average. That below this black line on this chart, this is when we get maximally defensive. And recent research has told us to give about a 2 to 3% leeway before things really break down. In this most recent case, that was below this 5,500 level, and that coincided with the Trump tariff tantrum that the markets threw. So one of the other comments that the typical Wall Street advisor will say is, you got to be right twice. You got to be right getting out, and you got to be right getting back in. Well, we're pretty proud here at Revere to detail every night on video exactly the steps that we're taking based on what the market is doing, because we've got a time-tested set of rules that tells us when to be allocated and when not to be allocated. So where does that leave us with the current market? Well, we had a reset for, a month ago. The China U.S. supposed trade reset led to a gap up, and that gap up has just plain and simple stuck. So it's stuck, meaning it didn't fail. We came down, tested it 2 weeks ago, bounced right off a key area where we should have. Most recently, when I did the video on Monday, I highlighted this 5-day tight range within this 15-day consolidation. We broke out of that range on Tuesday. And tested it yesterday with Musk and Trump feuding. The markets didn't take it that well. There was a sell-off and a test, but all we did is test the rising 8-day exponential moving average, bounce off of that, and then we gapped up this morning on a well-received jobs report. So we're kind of fond of saying that in most cases, during bull markets, pullbacks are buying opportunities, and that's we got shaken out. Well, I'm not going to say shaken out. I'm going to say our stops were hit on a couple of things yesterday, Tesla in particular. And let's take a look at that chart. This was plain and simple a sell signal on Tesla. Down on massive volume, breaking the 21, breaking the 200, and breaking the 50 all in one day. We're not deers in the headlight here. As soon as we saw it break below the 21-day moving average on volume, the slope of the line rolling over, we were out early in the day and just watched it continue to go down. Trying to recover today, a key area if you're still in Tesla is today's high coincided with the 200-day moving average, and we need to immediately get back above that level if Tesla is going to try to repair its chart. But look at that massive volume yesterday. So that's one that we got stopped out of. There was also a negative article out about Palantir that triggered some of our stops because it broke below the 21-day moving average. We use that as our short-term trend indicator. We want to be overweight something when it's above the 21. We want to be down closer to equal weight if it's below the 21, as long as it's still above the 50. But unlike Tesla, this has shaken off a good bit of that drawdown yesterday, reclaimed the 21-day moving average, and is up 4.2%. So a big difference between the quality of the chart and the destruction to the chart in Palantir versus Tesla. And we still have a core position in Palantir, and it's acting well. But if it breaks below yesterday's lows, we will probably dispose of the rest of it. We've got gains because we've owned it for a while. I'm talking about in our growth protection portfolio. So where does that leave us in the S&P 500? This 6,000 level is an area we've also been discussing in our videos as resistance. We're trading right at 6,000 right now at 12:10 on Friday afternoon. So one day of a test. The market has at this point survived the test. When you have a test like that, it makes the lows of that day a critical level to pay attention to. And when I say test, I kind of mean stress test on the market. So we pulled back, bounced at the 8. Bulls won this case, plain and simple, because we held a support level and we made higher highs. That's the definition of an uptrend, is higher highs and higher lows. And that would be broken if we made a lower low below Thursday's low. Then you're not in an uptrend anymore. You're back into being in a consolidation, because the breakout would have failed in that situation if we break below Thursday's lows. As for right now, the breakout is intact. This 59.6861 was the high of this 15-day consolidation. We broke out of it. So now we just monitor the breakout level, and more importantly, monitor the pullback level from Thursday when the market was stressed. Some leaders underperformed. Tesla broke down. Palantir was tested, but regained the 21-day moving average. And it's just taking it day by day, not guessing, not going by the headlines, not making predictions. It's about interpretation and it's about expectations. If your expectations get broken, right now our expectation because is that the market will continue to trend in the direction that it's going, which is up. But if we break Thursday's lows, that would be an expectation breaker. We would reset. We'd reset even more if we then did not find support at the ascending 21-day moving average. That's the green line here. That's what we use on our trend gauge every night to track the short-term trend. All the indexes right now are above their 21-day moving average. The S&P and the NASDAQ 100 are above the 200-day moving average. Let's take a look at the equal weight S&P. That tested last week but climbed back above the 200-day moving average. Equal weight S&P has been lagging, however. Notice that it hasn't made higher highs, and that's simply because the NASDAQ 100, with their big weighting, those types of stocks are heavily weighted in the S&P as well, and that's what's leading that higher. Dow Jones Industrial Average undercut the 200-day moving average, gapped back above it today. Mid caps, the MDY, failed at the 200-day moving average 3 weeks ago, still has not made higher highs. And small caps, still below the 200-day moving average, but this is a good sign here, breaking above this resistance level around 210 here on the IWM. That's the main small cap ETF, but still have the 200-day moving average above there by a couple of percent. So another important thing to monitor. Note small caps showing relative strength this week. They tested their 8-day moving average and held yesterday. But when they tested it, it showed some relative strength, and now breaking out today. Definitely a good sign for the market. Small caps have underperformed for a long time. Let's go to a weekly chart here. Look at the relative strength line on small caps going back to March of 23. They've been in a downtrend on a relative basis versus the S&P 500. No chart is complete without a relative strength line on it, because you can be misled by what's healthy and what's not healthy, but you got to have a relative strength line on your chart to be comparing.
Don, let me just jump. Let me explain that real quick. So what Don is saying is small caps, which carry more risk than large, stronger companies that don't have to worry about bankruptcy or competition as much. If large caps are stronger than small caps, you shouldn't own small caps. You're not getting overcompensated for the risk that they would be providing. And that's even in a pie chart to Russ portfolio. Those guys should be looking at that, and they should be moving the pie charts to the strongest the good stocks, not the rotten stocks. You don't want rotten fruit. You don't want rotten stocks. Sorry, Don.
That's fine. And Dan, you bring up a good point about small caps. Modern portfolio theory and academics like to say small cap value stocks have historically outperformed the large caps of the S&P 500. That's exactly how they say it in that voice with that intonation too.
Oh yeah, with mahogany wood behind them panels and the diamond pinky rim.
But what they're not looking at is what's happening in the small cap sector. Why have they underperformed recently? The landscape has changed. The bigger companies that are out there gobble up these smaller companies. They purchase them, they acquire them. Just as soon as they show some sort of a promise that a larger company can think is accretive to their business, they're going to buy these companies. It's not common to see these small caps grow up to mid cap and then to large cap. It's not as common as it used to be. The other thing is venture capitalists keep these things private way longer than they should have, so that they can jack up their valuation. And when they come public, they're not coming public as small caps anymore. They're coming public as mid caps or large caps.
With a higher valuation. Yep.
There's a change in the landscape that doesn't show on the academics charts when they go back 60 years looking at small caps, claiming that they're going to outperform. This has been a long period of underperformance in small caps, and it's just being glossed over by the academics claiming you have to have small caps in your portfolio. Now, there could be a time for small caps, and we'll be on it when there is. But for right now, it's very clear from the relative strength line and the fact that they're living below the 200-day moving average that this is the equivalent of buying rotten vegetables to maintain a balanced diet, because it's not showing relative strength. In Revere, we want to be in uptrending, outperforming asset classes and sectors and stocks.
Yep.
Plain and simple. Dan, do you have any interpretation to do to that? Anything you want to add?
Just price is truth, no exceptions. So Don was giving
Exactly.
you price and relative strength is truth, no exceptions. There we go.
Yeah, that's a good point to add relative strength into every consideration that you do. Let's turn it over to the fellas now who have some very strong presentations this week. We're going to start off with Todd, who's going to take a look at the precious metals, which had been leading, took a little bit of a break for a couple of weeks, but are they re-emerging again as leaders? That's the question everybody wants to know. Todd, take it away.
Silver and gold. And why are we talking about this today? Well, silver this week broke out to 13-year highs. And if you look at the weekly chart on silver, you can see that it's slowly been stair-stepping over the last couple of years. And finally this week, it's broke out to 2012, 2013 levels. But before we go on, let's just do a quick revisit of the gold to silver ratio. Currently, we're at 93, which means it takes 93 ounces of silver to buy 1 ounce of gold. Recently, in April and May, it took over 100. And historically, the highest it's ever been was COVID, which is 125. And over the years, 50 is kind of the norm. So we potentially have a little bit of a tailwind there because we are at extremes in that ratio. Throughout history, both gold and silver have been positively correlated, but this past year, gold has substantially outperformed silver, and it's gold's up about 40%, silver's up about 17%. So it's been a laggard, and now is it silver's time to catch up? Now, the big difference between gold and silver is gold is more of an investment metal, where silver has more of an industrial component, although it is also a precious metal and has an investment component to it as well. And over the last year, gold's been particularly strong, primarily because of the uncertainty that's going on in the world, everything from trade policy to geopolitics to central banks like Russia, China, and India on buying sprees of gold because they want an alternative to the dollar. But if we look at silver right now, one thing that I find interesting is silver and copper are both fairly strong right now. And Don, if you could just pull up a quick comparison chart of CPER to SLV just for the last year. And one thing that's really happened here recently is there's been an extreme high correlation between the price movement of copper and silver, both of which are industrial metals. And currently, over the last year, that correlation is about 0.9, one being perfect correlation. And right now, we're just about perfect correlation over the last year between the two. And both are industrial metals. So is this signaling something bullish going forward? I have no idea, but that correlation is very strong between these two metals. Finally, let's just go through the charts on a couple of stocks in this area. First, let's do the GLD. And right now, the GLD is in a nice consolidation, about 8% deep. And it's taken a little break after making all-time highs in April and trading constructively. Relative strength has been declining as things have settled down in the market after all the turmoil that took place in April with the trade policies. It's backed off, but it is in a constructive 8% base right now. We look at GDX. GDX is leading and miners recently broke out as well. However, they're pulling back. So there has been some relative strength in the mining stocks at large. In terms of silver, there's not that many publicly traded silver companies, but the two I want to mention, one is Pan American Silver, PAAS, and very volatile stock, very choppy. And incidentally, silver is much more volatile than gold. But this recently hit the all-time highs here yesterday, but backed off a little bit today. So, I'm sorry, not all-time highs, multi-year highs going back to 2020. So it's up against a little bit of resistance here. But good price action there. And the final stock is WPM, Wheat and Precious Metal. This one looks a little bit better. It's got both gold and silver in it, so it's a little more stable. And again, that one is at all-time highs. So that's the end of my presentation. Just wanted to kind of bring this silver breakout that's taking place.
And one thing the listeners can do, one thing that helps is when you do take positions in the precious metal stocks, just like with oil, if it's a commodity company, a commodity backed, like all their profits and all their earnings are based on the commodity itself. A lot of times you want to key off the futures price or the commodities price once you take, that'll help you manage a position. Don't just look at the stock price. Sometimes the commodity will start breaking down before the stock starts breaking down. Anyway, go ahead. Don?
Yeah, thanks, Todd. And we're going to turn it over now to Connor, who's going to take a deep dive into a company that was affected yesterday by the feud between Musk and Trump, and he's going to explain why and take a look at the price action.
Yep. Thanks, Don. Yeah, so Rocketlab is a current holding in TurboTection right now, and I just kind of wanted to talk about what's going on here and what we're seeing. So I'll start from the beginning. 527, that was when we took our initial ad on Rocketlab, and you can see it was breaking out through that $26 level, good relative strength, and then it made a day two higher high, and then it started to pull back. So the position was under a little bit of pressure, but the thing with this stock is it's more volatile in nature. So, we have our RVAB, and that's how our position sizing is determined. So, for these types of stocks, we take smaller size and use a bit of a wider stop, because if you have to know the nature of your stock, and if you're using too tight of a stop in a volatile name, then you're just going to get stopped out quickly. And then so it started to come back in, and then yesterday we doubled the position as it held the 21-day moving average. But what I wanted to talk about is why this stock may benefit is, first of all, the administration is super focused on space. Aerospace and defense stocks have done really good this year. They're the 5th ranked industry group per market surge. So again, leading groups, leading stocks, that's what we want to focus on. So right off the bat, that aerospace, defense, space related stocks is the place to be, and especially with the administration being very pro space. So, and if you haven't been living under a rock, I'm sure everyone has seen the Trump and Elon Musk, battle yesterday. And instead of dwelling on it, we're investors. Our first thought is, how can we make money in whatever environment? And one thing, this started to pop. This is up 8% on the day. But basically what happened is that with the public feud, the SpaceX government contracts worth an estimated $22 billion are at risk. And Trump has openly threatened to cancel federal contracts with Musk's company. So inherently that's bullish Rocketlab, and with or without Elon, there'll still be investments into the space. And then recently, Ted Cruz is seeking $10 billion for NASA programs. in the budget as well. So again, there's a lot of money flowing into this space. The stock's acting positively off that news. You have the 21-day right there, which is not too extended from the 21-day. And this was a very powerful stock in 2024. You can see that massive move that it made, and then it obviously pulled back. And if you go to the weekly chart, I noticed this yesterday as well. Wasn't on my radar back then, but a previous podcast, I talked about the 3 weeks tight at the 40-week moving average. And you can see Rocketlab had that. So again, on that pullback, to me, that's a sign that institutions were stepping in into this one and supported it. Harsh pullback, but again, that was a function of the market. And now this one's trying to get back up to the highs here. And with with the administration bullish on space, leading industry group, great relative strength on this stock. Hopefully this one can continue higher, but so far it's acting quite well today, especially after that news yesterday.
Good stuff, Connor. That's, a good point that you made is, it got up to the 30 area where it found resistance from back in January and February, but this is just starting to complete a base. This could really take off. This has the opportunity to really take off to the upside if it breaks above this 30 level and this all-time high. Let's see, is it an all-time high? I imagine it is. Yeah, a lot of a big spike after its IPO back in 2021, very deep base, but great comeback up the right side of this deep base, consolidation, and good low-risk entry here. Especially for the ad yesterday off the 21-day moving average. Good
that was great
there.
timing. Yep. And who said
right,
you couldn't time the markets? Ha!
You can't time the market, Dan. It's on. I have it on good authority from Wall Street pie charts and academics. Yeah.
Yep.
Because you have to get it right on the sell and the buy, and that's just impossible.
And by the way, I don't know if the listeners know, but modern portfolio theory has been debunked. It's sequence of returns have kind of destroyed modern portfolio theory.
There are people that would fight you on that tooth and nail to protect their paychecks, Dan.
Oh, I know.
All right.
That's why we have such a big growth rate, Don.
That's right. Ted's going to take control of the charts now and talk about some crypto.
Teddy Bull.
All righty. Yeah, I'm back with another segment on Bitcoin. I've been talking about Bitcoin the last 1.5 years, and I'm back again. I think for me, this is the best breakout proposition in any market right now, and I'm extremely bullish looking forward the next 3 to 6 months for Bitcoin. Just in a more zoomed out view, for all of us at Revere, we like to trade clean charts, linear charts, whether it's an uptrend, downtrend. And if you just look at Bitcoin in the last 5 years, when it makes an up move, it's extremely linear. And then when it corrects, it's linear. And it respects moving averages quite nicely. And that is one of the first criteria we like to see in the charts we trade. In this most recent price action, we had this multi-month breakout from the election, and we made a nice move. And it's so far corrected, but again, super linear, super tight, really respects moving averages, respects price structure as it did during this crash, and it held the 74,000 level. And we started noting that relative strength in this era right here. And we talked about in the podcast and the daily videos as well. And we are involved in Bitcoin here. I think I did another segment in this other area in this late April time. And I want to go on a daily chart now because I said around the sub 100,000 in this 95,000, 96,000 area, I was hoping for something maybe below 100,000, put in a handle before you continue higher, so the moving averages could catch up to price. But we did blow past 100,000 and even all-time highs at one point. And that really left us extended from the moving averages. And typically when that happens, you really need to have some back and fill action. So far, you can say this is a failed breakout, but it's not really violent. You haven't really seen huge selling pressure either. So just more of an extended name straight up off the bottom, 7 weeks up in a row. And it was up 50% for Bitcoin in 7 weeks. Is pretty large. So now just perfect digestion action. Again, really linear. It's forming this bull flag here. If you can visualize some trend lines. And yesterday, we found support at 100,000. So that is another indication of perfect price structure. We're turning that 100,000 Livermore level into support now. The 50-day has caught up as well. And today we're rallying and putting a nice inside day
So the
And
50
on
is
the
the
weekly
red.
chart,
The 50 is the red.
yeah, the
Or
50 is the red.
Okay.
And then the 50 is the red. And on the weekly chart, the red is the 10-week. And as you can see, there's still this little gap of price action right here from the 10-week at 96,000 to the lows of this week, 100,000. I would love to see the moving averages close this gap, and you can see these three MAs are really stacked and starting to expand. So in the next few weeks, I would expect, my expectation is that we see a breakout happen over 108,000. And the next time that happens, I believe we'll take out all-time highs, and that will truly mark the next leg up in Bitcoin. And like I said, when we had this 7 weeks up off the lows, there was no symmetry. If you just visualize this, you can see this side of the base has a lot more price action, a lot more consolidation than this straight up off the bottom. When that happens and extended from the moving averages, this is what you'll get. Some back and fill action. And now you can see there's more symmetry in the base. If you were to draw like a horizontal line down here, this is the left side of the base, this is the right side of the base. This back and fill provides that symmetry. And when you have symmetry, it's just supply and demand working itself out, strong hands accumulating Bitcoin away from the weak hands, the late chasers, or just people who time the lows and want to get out for a swing trade. So I think this is ready. And this is the first part of my thesis, the price action, the price structure. The second part, if you look at Bitcoin on Google Trends, the highs in searches for Bitcoin was late 2024, and that correlates with in this area. But as Bitcoin has consolidated and moved back into new all-time highs, the search results or search queries for Bitcoin actually has plummeted back to the September, October lows. So that, to me, is nice. That just means people aren't searching for Bitcoin, and it's potentially not crowded when the breakout does happen. And thirdly, in the commitment of traders data, which is released by the CFTC for the futures, the green line on the bottom is large speculators. And large speculators are putting on more and more short positions as Bitcoin heads higher. Even to all-time highs, they increase their short positions. And for me, you want to take the opposite side of large speculators. You want to take the side of commercials, which is the red, and they're just starting to get long here. So when the breakout does happen, large speculators are probably going to be pressured to cover, and that'll just fuel the breakout even more. So
Ted, let me explain that real quick. So the speculators are kind of the guys that are just playing the game and trying to, make money and just take a shot. The commercial, those are the people that are actually in the business, that are actually in the business of working the commodity and doing it. And it's kind of like with Wall Street and stocks, the smart money and dumb money, or the retail money and the institutional money. That's kind of what that is. So normally you're going to favor the commercial interest over the speculator. So what Ted is saying is the professionals are starting to go long, while the rookies or the speculators are going short, and they're trying to bet against the trend.
Right. So taking all three of those factors, the price structure, cup with handling, moving average alignment, just great strength up the right side, trading near all-time highs, the Bitcoin trends on Google Trends heading to historical, well, not historic lows, but lows of the last 12 months, plus the commitment of traders, large speculators heading more short. I think that blend, that cocktail provides a pretty great proposition for a Bitcoin breakout trade when it does happen. And
so you're watching for that to break through the resistance to then become support.
Yep, to put on the full trade. But just for full disclosure, we did have a 1/4 position starter in this area, and we added more, I believe, in this area, and we've just been staying patient for the final adds to our Bitcoin position in Turbo.
Okay. All right.
That's it.
All right, good stuff, Dan. That's it from the technician side of the shop. You can take it on home.
Well, folks, I started the show with, what is price telling you about your money? And what does your advisor sound like? Does your advisor sound like these guys? These guys do this 7 days a week like that. They eat, breathe, and sleep this stuff. In fact, I got to make sure I put my phone on silent. Otherwise, I'm getting text at 5:36 in the morning with Ted and Connor talking about a stock breaking out before the open. I was getting Ted's comments from Italy at 3:30 in the morning. By the way, bon mille, Ted. That's that. Thank you in or grazie mille. That's thank you in Italian, folks. Listen. If you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. This podcast will be delivered to you in your inbox on Saturday morning, tomorrow morning. We're recording this Friday morning, 10:30 Central Time, and Zach will have it out by about 1, 2 Central before the market close. Our YouTube subscribers, just go to YouTube and just look for Revere Asset. Hit subscribe. You'll have this before the market close on Friday. Then we do a daily market insight video every day the market's open. You'll get that in our inbox, or you can get that on our YouTube channel. Then next to that, there's a contact us button. You can put in you want a complimentary portfolio review, or you want a stock or a bond, or whatever you want talked about on the show, or a topic. And you can always call us old school at 855 Real Wealth. Folks, the gold nugget of the day that Don said, one source of alpha is knowing when to increase your beta. What he means is you got to know when to put on the gas when the risk is clear, when the coast is clear, and then you've got to know when to put on the brakes so you don't get T-boned by the S&P running a red light. At Revere, we're making S&P-like returns, but we have brakes. We're going down a lot less. Learn a better way to invest so you don't get a Pie Charts or Us portfolio from some stripmalladvisor.com. We'll talk to you next week on Your Money, not Their Money, Your Money.
Because it's not how much you make in the markets, it's how much you can keep.